In a world of financial turmoil and unreliable information, it becomes very difficult to make sound financial decisions. Add the fake guru epidemic prevalent on the internet and you have yourself a recipe for disaster. There are dozens and dozens of figures and formulas around anything related to investing, but some of us, me, are math deficient, and even if we are math savants, it makes no sense to try and remember 50 different formulas every time you make a financial decision. So if you have these few back pocket rules in mind, the mathematics of investing will be less mysterious. Rule 1. The multiply by 25 rule. The whole premise of this video is financial freedom, hence an obvious answer you guys are looking for is how much I need to retire. Well, let's do the math. First, you'll need to know how much money you spend a year. You can't predict the future, of course. Will you have paid off your home by the time you retire? Will you want to move to an area with a higher or lower cost of living than where you currently are? How much more expensive will necessities be in the future? You can't answer those questions, but it's good enough to use the number that represents your current yearly expenses. None of these numbers are meant to be an exact science, just a rough, ballpark figure. Let's say you need $50,000 to live on per year. Multiply that number by 25. $50,000 times 25 equals $1,250,000. Now, here's the caveat, 25 is based on old data. People are living longer, and healthcare is more expensive now than it was when this formula was devised. The new number is 34. $50,000 times 34 equals $1,700,000. There are two other things we need to factor into our number, inflation of course, and how far out retirement is. Your $50,000 today is worth $50,000, but in 10 years, it's worth less because of inflation. You can account for inflation like this. 10 years from retirement, multiply by 1.48. 15 years from retirement, multiply by 1.8. 20 years from retirement, multiply by 2.19. 25 years from retirement, multiply by 2.67. Let's assume that you want to withdraw $50,000 per year from your retirement portfolio, and you're 25 years away from retirement. Multiply $50,000 by 2.67 equals $133,500. That number is your inflation-adjusted target. To summarize, the rule of 25, or as it turns out 34, gives you the total money you need to retire, as per your retirement timeline. Rule 2, the 4% rule. This rule can be simply understood as the corollary of the rule of 25. If the rule of 25 gives you the total amount you need to have before you think of retirement, the 4% rule tells you how much money a year you could withdraw without running out of money, because the gains your remaining investments make will replace that amount each year. So, once again, let us do the math. We assume you have $1 million, at 4% it comes out to be $40,000, right? Easy. Well, not so much. Once again, the 4% number is from the 1990s based on something called the Monte Carlo simulation. At that time the 4% rule was valid with a 95% certainty. So, back then you could have $1 million, pull out 4% each year and the money would have lasted for 25 years. The number once again is not the same anymore, it is closer to being 3.2 to 3.4%. So maybe a little more of the austere lifestyle, or save 1.3 million instead of 1. Guys, a quick point to make before we move ahead. One thing I need you guys to understand right now. All these math rules, yada yada yada, works when you have some money. It makes no sense trying to work around with frugal amounts and hope investing would make you rich. My friends, my intention is not to clickbait you to a video and sell a dream of being a millionaire with your current small income. I will keep it 100% real with you. If you want to have serious money that you can invest and also live a good lifestyle, you need to increase your revenue sources. More revenue sources give more money, which when invested right generates even more money. Don't let people on YouTube fool you. They don't tell you the backstory of their lives and try and sell their knowledge as the gospel. Do not fall for that. If you are young, even in your early 30s, and you don't make much money, you are supposed to save a little bit for the future but invest most of it to increase your skill level so you can start making more money quickly. A great way to do that is online, using the internet, where investment is minimal and your target market is essentially the entire world. If you want to learn about that, check out my other channel, The Online Biz Consultant, the link in the description. I provide consultancy, not a genie. There will be no shortcuts, no $10,000 in 2 weeks types of videos. But if you are serious about changing your lives and increasing your income, using the internet, in a sustainable and long-term form, follow my other channel. If making $10,000 was that easy, as portrayed by gurus, why on earth will anyone ever work, including the gurus themselves? So, with that out of the way, let us get back to the remaining rules. Rule 3, the Gordon equation. You've heard various numbers when people talk about how much you can expect to gain on average in the stock market. Our number is 7%. But where did we, or anyone else, get that number? Via the Gordon equation. No, it has nothing to do with Commissioner Gordon who is awesome, or Gary Bettman, the NHL commissioner who sucks and is the reason I am no longer a hockey fan. The equation looks like this. S&P 500 dividend yield plus about 4.5% equals the expected long-term return on stocks. Current dividend yield equals 1.75%. 1.75% plus 4.5% equals 6.25%, current estimated long-term return of stocks. And by current, we mean the day the podcast was recorded. The number fluctuates. The 4.5% represents the average growth of dividends. Rule 4, Rule of 72, 114 and 144, double, triple, and quadruple. Everyone's heard of the Rule of 72, kind of a YouTube guru favorite. This rule essentially tells you how much time it takes to double your money. Once again, let us do the math. If the return from your investment is at least say 7.2%, number chosen for ease of calculation. So, 72 divided 7.2 equals 10, at a 7.2% rate of return your money will double in 10 years. The same principle can be applied to check the time needed to triple and quadruple your wealth. Divide 114 by the rate of return to calculate the tripling time and divide 144 by the rate of return to calculate the quadrupling time. Rule 5, the 1% rental rule. This rule is for all my property guys out there. It is very simple to understand and I will explain it in one line. The 1% rule lets you know whether a property is a smart buy or not. If the monthly rent on a home is 1% or more of the purchase price, it's a money maker. If the house costs $100,000 and you can charge $1,000 a month, shortlist it. Alright, guys, this brings us to the end of the video. If you found the video informative and useful, make sure to like, share and subscribe to the channel. I will be posting similar practical content regularly, every 2 to 3 days, so make sure you have clicked the bell icon as well, so you get the latest notification. Take care of yourselves and your families. God bless us all. Thank you.